Chapter 3, Source Number 2, Peer-to-Peer Lending. Conventionally, if someone wants to buy a house or a car, he or she approaches the bank for a loan. Applying for a loan from the bank is a lengthy process. You'd have to apply for the loan and wait until the bank approves it. Meanwhile, the bank would accept or deny your loan application based on your credit history. Nowadays, the picture is quite different. Getting loans have never been easier. Tons of websites and applications are ready to disperse loans to you without any hassles. This is commonly known as peer-to-peer, P2P lending. An introduction to P2P lending. P2P lending provides a medium for borrowers and lenders to interact with each other. P2P lending is often seen as an alternative to banks. It has gained a lot of popularity in recent years. Some of the most popular P2P sites include Lending Club, Society One, Rate Setter, Balmain, Private, and so on. Generally, P2P follows the concept of crowdfunding. It is all about convincing investors to help you fund your project. P2P lending business borrowers apply for loans that are provided by investors online. Just like the banks, these loans come with interest rates. Borrowers share all documents to the websites as they would to a bank. The websites do the necessary verification, such as personal identification, credit history, etc. The interest rate of the loan is set based on the risk profile of the borrower. Finally, the website puts up the application on their portal for the lenders to see. Subsequently, the lenders review the applications on the website and decide who they want to help out. Lenders have the option to help someone fully or partially. When the loan has been completely funded, the website platform turns over the money from the lender to the borrower. Users of these website platforms also have to pay a fee. When the loan is done, the website platform becomes responsible for the loan service. They become in charge of processing repayments as well as dealing with missed payments. In case of the borrower misses a series of payments, the website platform becomes responsible for their collection of the debt. Consequently, the lender bears the losses. Peer-to-peer lending is a highly tempting proposition for investors. This is because they are able to lend small amounts of money to borrowers and gather interest recurrently as the borrowers pay their debts off with time. Almost half of the P2P loans are utilized to pay off credit debt as very low interest rates. So, if you face a tough time paying off your credit cards, you can resort to P2P lending. How to get started? In some of the most prominent P2P lending platforms, entities and commoners can both become investors. All they need to do is meet some standard requirements. To begin with, interested investors need to be financially suitably in the state. What does this entail? This means that in order to be eligible as a lender, you have to be a resident of one of the states included in the list of the P2P lending platform. Plus, you need to comply with the financial suitability conditions of the state. In case you happen to live in a state that is not listed on the platform, you need to comply with certain requirements to prove your financial stability. For example, you need to provide proof of your yearly gross income. Depending on the P2P lending platform that you choose, you need to have a certain sum of money for your annual income. Plus, you need to have a net worth of the same amount or greater. Your net worth is calculated on the basis of your home, cars, and other personal assets. You also need to have your identity verified on the platform. Investors need to be above 18 years of age and have a social security number. Companies, organizations, and family trusts should also get in touch with the P2P lending platform that you want to be part of in order to verify your identification. In most of the cases, the P2P lending platforms do not ask for a minimum balance on their regular investing accounts. Nonetheless, it is important for you to be prepared in case the platforms decide to levy minimum balances on their investing accounts in the future. You can invest whatever amount of money you have as an investor. For example, if you plan on investing $35 in a loan facility advocated by a P2P lending platform, a $3,500 investment will allow you to diversify for as many as 100 notes. You should be aware that diversification, which is about scattering out investments consistently across notes that are associated with borrowers, has the capacity to give returns that are much steadier than the ones that come from single note investments. How to invest like a pro. So now that you have a fair idea of P2P lending, do you reckon that investing your money is the right thing to do? In case you want to become a lender, you need to demonstrate that you are actually capable of providing funds. As I already mentioned before, there are a set of requirements involved in the sign-up process. You need to provide the appropriate documents that prove that you are a suitable investor to the P2P lending platform. In most cases, if you have a net worth of at least $200,000, you are good to go. It proves that you can back up the loans you offer. Similarly, if your gross yearly income is $70,000 or more, you are on the right path. Having this much money automatically qualifies you as an investor. In most cases, investors are asked to pay 1% of their total income to the P2P lending platform that they form a part of. Moreover, P2P lending must be legal in the state the investor resides in. Even if you meet the necessary requirements to become an investor, getting started with P2P lending is a daunting task, especially if you do not have any prior experience. Some investors get too excited and immediately dive into the depths of P2P lending without having a proper plan. This is a big problem. Consequently, they end up dissatisfied over their investment returns. If you desire to make solid profits from P2P lending, you have to consider some factors. I am sharing some important pointers for you below. 1. Cherry pick auto loans. The very first decision you make is to decide on whether you should invest in individual loans or choose to go with an automated plan provided by a P2P lending platform you have signed up for. If you have a substantial amount of money that you wish to invest, you may want to choose the automated plan. 2. Diversification is the order of the day. If you are new to P2P lending, you have to diversify. You should by all means refrain from pulling all your eggs in one basket. You should spread your opening investments between loans as much as you can. It is a great idea to diversify your opening investments as widely as possible. 3. Do not get carried away. We have all heard the phrase, shoot for the moon, so that in case you missed it, you will still land among the stars. This proverb is not an ideal one in the case of P2P lending. Let's assume that you get an opportunity to invest in grade A loans that earn about 10% interest. On the other hand, you also get the opportunity to invest in loans that earn more than 15% of interest. Between 10 and 15%, which one is more ideal? Of course, the answer is 15. While this is true, it is much safer for you to go for the former. In the case of P2P lending, you may want to choose the option that carries a lower risk. This is because greater interest rates also mean greater risks for borrowers. Remember, these are the kind who usually have a higher default rate. 4. Advocate the use of small filters. Once you have transferred your money, you may have an idea of investing in each loan. This may cause you to log into your P2P loan account and browse for site listing loans. However, as you examine one loan after another, you begin to see that it will really take a long time to see everything. You could spend all day looking at a loan. Therefore, you need to reduce your selection to a reasonable size. 5. Review each loan carefully. You need to spend a lot of time to read about the details of loans listed on your P2P lending platform. As an investor, you may want to avoid borrowers who did not bother to provide a good description on their loans. You may also want to avoid those who fail to answer basic investor questions. Of course, you should always take their answers with a grain of salt. You don't necessarily have to doubt the integrity of the borrowers, but you should also rule out the possibility of some of them that are not telling the truth. 6. Begin gradually. New investors are often excited to start and to do what advanced investors do. However, you shouldn't be too hasty. Do not make any decisions until you have considered all the options. It's good if you follow the tips mentioned above. By the time you start investing your money, you should have already narrowed down your choices. You should have already settled the loans based on their grade, delinquency, etc. Say you have $3,000 for your opening investment and you are looking at 40 different loans. You may think that you only need to invest $50 in each loan. However, that should not be the case. Instead, you should stick with diversity. Stick with investing $25 for each loan. You have to invest half of how much you have today and then wait 1 to 2 weeks for a new batch of loans to be listed in your P2P lending platform. When that time comes, you can do the same process and invest your money in several loans. You need to be patient and well organized. 7. Try to avoid. The interests you earn on your investments are actually taxed at a standard rate for income tax, not at the more favorable rate for stock dividends. Thus, if you belong to the 28% federal tax bracket, you have to pay 28% in federal taxes on the interest income that you make from P2P lending. If you want to avoid experiencing problems with taxes, you have to put your investments in an IRA. Lending Club and Prosper actually offer an IRA without a fee. You can join with $5,000 as your minimum investment amount. Every one of your interests will be tax-free. There are several options you can choose from, such as opening a new traditional IRA, a SEP IRA, a Roth IRA, or rolling over your current retirement account. 8. You need to have an emergency fund. Before you invest your money in P2P lending, make sure that you have enough money to cover both your personal expenses and investments. Remember that once you've lent your money to someone else, you won't be able to get it back for a while. So, if something suddenly comes up, you might not be able to spend that money. If someone in your family gets sick, your home is damaged by fire, or something unexpected happens, you need to make sure you have the money to cover it. I hope you will be able to understand the potential of P2P lending in the long run. This could be the secret of your success. However, you should have a complete idea of the process involved to get started. Once you achieve that, you are good to go.